Okay, Business 20 students, this is Mr. Doucette, and this is my look at chapters 15 and 21. And I'm going to be going over some problems that you will encounter working through these chapters. And so I'll work them out on the screen here. I'll try and separate them from chapters 15 to 21. But chapter 15 is on what we call financial statements. And of course, every business operates utilizing three financial statements, which is the balance sheet, the income statement, and the statement of cash flows. In this class, we don't really do much with the statement of cash flows, but we do work out some various calculations for our balance sheet and for our income statements. Most prominent two or most popular two forms of assessments of these two documents are what we call vertical analysis and horizontal analysis. Vertical analysis is just comparing your figures within a financial statement with itself. So based off of total numbers, what percentage of cash is what percentage of cash to total assets is there, things like that. And that's what we call a vertical analysis. And then horizontal analysis is where you look at 2 years side by side or 3 years side by side, and the amount of change, what percentage of change was that, etc. So these are valuable to a company, especially if they set some milestones or some standards that they want to follow. Like, for instance, they might say, well, we never want our cash to drop below 10% of our total assets, something like that. So they want to keep track of that. So they make sure they're in a good financial position cash wise. So we'll talk about all of that, and hopefully it'll make a lot of sense by the time we're done. But I do want to refresh your memory from last week. We did talk about the various financial statements. And here I have on your screen once again a balance sheet. And the balance sheet is basically always broken into three primary categories. One of them is your assets, the other one is your liabilities, and then the third one is your owner's equity. And as I've mentioned a few times now, there is what we call the accounting formula. And it's basically up there at the top. Assets always equal your liabilities plus your owner's equity. So if you notice, my total assets here are 1.886 million, and my total liabilities and owner's equity are also 1.886 million. So they have to equal each other. This is where the double accounting or double entry accounting system holds you accountable, because if they're not the same, that means somebody made a mistake somewhere. So they could go back and figure out where the mistake was made. That's what we call the accounting formula. You can also, an easier way to do it is to look at the second way to draw it up, and that is your assets minus your liabilities. So assets is everything you own, and then your liabilities is everything you owe other people. So if you take all of your assets and then you minus everything you owe other people, and you were to, liquidate everything you had, pay off all of your debts, whatever you have left over, that is your true owner's equity. And so if I own a business and I decide one day I'm done and I sell all of my assets, and I take all of my assets, buildings, equipment, property, finished product, etc., and I cash it all out and I pay all my debtors off, whatever I have left is mine to keep, right? And that would be my owner's equity or owner's dollar value. So if you see here on your balance sheet, your assets are broken into two categories. Your current assets, which are things that you can turn into cash fairly quickly. These are things that are due or that are active within a few months. And then you have your property, plant, and equipment. That's the second category. And though that category is more long-term investments or long-term assets, a lot harder to get rid of typically, but things like equipment, land, as it says, their property, plant, and equipment, any kind of investments that you might have. And of course, Sienna's Health and Fitness has a lot of investments because they're saving to buy 25 acres of land, and they're going to build a facility on it. And then the second part of your balance sheet is your liabilities. And so your liabilities are also broken into two categories. Your current liabilities, these are the ones that you're most currently or most recently, or should I say most due. They're going to be due the soonest. And so you'll have to pay those right away. And then you have long-term liabilities, which are things like, again, land, building, mortgage, equipment, etc. And those are going to be long-term liabilities that you're going to have to own or owe for over a long period of time. And so those two things on your liabilities total in this case to 443,000. And then, as I mentioned, in this case, owner's equity, they have some stock and retained earnings. So altogether, they have 1.4 million. That's in their savings and stocks and stuff that they're put aside. So they have 1.886 in total liabilities and owner's equity, as well as 1.886 in total assets. So we're going to be looking at in a few moments a balance sheet and we're going to actually draw one up. That's the first problem on your work for this week. So let's go ahead and go there. I'm going to open that project and we're going to call that chapters 15, page 1. So this is what it looks like. It says using the following financial information, prepare a balance sheet as of December 31st, 2016 for Keystone Auto Repair, a sole proprietor owned by Blake Williams. So again, if we were to break it down, we would just put assets. I spelt it wrong. And then we would have liabilities. And then we would have owner's equity. And remember, these need to equal these added together. So again, assets are broken into current assets and then also long-term. So current assets are the first things that are mentioned here, cash. Oops, I hate when it does that. It's probably not going to let me do it now. Oh, see if I can go back a little bit. All right, well, there we go. Okay, now I got it. Hold on. Got to get it back to where I can see it. All right, current assets. Darn it. That's why I hate the iPad. I'm getting something new, by the way, to do this because iPad is really clunky. All right, so current assets are cash. They're also accounts receivable, so we'll just put AR. And they're also merchandise inventory, so we'll just put INV. And then prepaid salary, 235. Oh, sorry, I didn't do that. I should have given myself more room here. Was that third one? It was inventory. And then we had prepaid salaries. And we had supplies. So those are all my current liabilities. And I would put the dollar value next to them. So it was 500, for that one. It was 2,800 for accounts receivable. Inventory was 2,700. Prepaid salary was 235, and then supplies were 3,900. So I add all those up, and that comes out to what we call my total current assets. So if you add all that up, it comes out to 14,835. So I'll put that here. And then I'm gonna have to move everything down because I don't have room. So I'll draw that other one later. And then I have my plant, property, and equipment section. And in that one, I have land, I have building, I have fixtures. It says fixtures. Let's see. I have tow truck. Is this correct? Yeah, land, building, fixtures, tow truck, tools, and equipment. So that would be drawn there. Then I would put the dollar value in for each of those. So the land was 55,000. The building was 74,000. The fixtures were 1,200, not 12,000, sorry. The tow truck was 33,600. And then the other one was 45,000. So if I add all those up, that would give me my total plant, property, and equipment. PP&E is what they often call that. And that comes out to 188,800. So if I add both of these up, it comes out to 203,635. So that's how much I have in total assets. is $203,635. All right, and then if I get to my liabilities, which is the second section, I have the same thing. I have current liabilities. And my current liabilities come out to, let's see, I have accounts payable. So we'll just do EC, accounts payable, for 61,800. I have notes payable. That's things that I owe on. Payable. That comes out to 17,600. And then I have taxes payable. That means I owe this. And that comes out to $3,540. So I add all that up, and that gives me my total current liabilities. That's going to be 27,940. And then I have my long-term liabilities next, and that's going to be mortgage. And that came out to 51,000. So that would be added here. Oops. 51,000. So if I add those both up, it comes out to 78,940. That is my total liabilities. Equals 78,000. And then I have my owner's equity as the last section. And then I have capital, Blake Williams capital is the last thing. I hate this iPad. I'm getting something new. That was 124,695. So I'm going to add that to the 78,000. That comes out to 203,635. And that's total liability and owner's equity. So the same, 203,655, 203,635. Not 655, 635. So basically that was a really rough example of drawing out a balance sheet, but just remember you have these main sections, assets, and then current assets and long-term assets, which are plant, property, and equipment. And then you have your liabilities. So you have total liabilities is the second section. You have current liabilities. You have your long-term liabilities as well, here and here. And again, the current liabilities are things you owe in the very near future, the next couple of months or sooner. Long-term liabilities are things you owe many years from now. And then so I added all that up and I get my total liabilities. And then my last section was the owner's equity. And that really is whatever's left, right? After my assets have removed, after I removed all my liabilities from my assets, whatever's left is owner's equity. In this case, they actually have a capital company that they have money at. So it's $124,695. And when I added that to my total liabilities, it came out to $203,635. All right, so that's basically how you do a balance sheet. It's very, very poorly done on this iPad. I want to apologize for that. So I'm going to close that page and open a new one, which will be the next page for us, and that's 2. So this is where we start getting into what's called a vertical analysis, and this is where we're going to be comparing all of our different assets to our total assets. So if you notice, next to total assets here of 308.55, this is a whole different company, I put 100%. That means that I am going to figure out what percentage of every one of my assets are a part of total assets. And again, this might be kind of my way of saying, hey, I want to make sure my cash doesn't drop below a certain percentage of my total assets, or I don't want to make sure my inventory doesn't go above my total assets. So I need to figure out the percentages then of each one of these categories all the way down to the 308.55, 555. And the way that you do these is pretty simple. You basically just take the number 3,400 and you divide it by the total 308,555. And that's going to give you the answer of 1.19%. it'll actually give you an answer of 0.0119, but you need to move the decimal point over to make it a percentage, so it comes out then to 1.19%. And you would just do that all the way down. You take the next one, 5,600, and divide that by 308,555, because that's the 100%. Kind of like this, back to that portion formula we did, the percentage formula way back in chapter 6. And that would come out at the end of the day to 1.8%. And if I just keep going down, the 98,700 would come out to 32%. The 455 would come out to 0.1%. And then the 800 would come out to 0.3%. And if I add all those up, it comes out to 35.3%. I would also be able to divide this full total amount by this amount. So 108,955 divided by 308,555, and that would give me an answer of 0.353, and that would give me the 35.3%. So anyway, I'd go all the way down with all these factors, all dividing them all by the 308,555, and whatever percentage they are means that is the percentage of that category to total assets. And it's pretty simple to do. That's what we call vertical analysis. Again, now I can go back and look and go, okay, well, that means that cash is 1.19% of my total assets. And I might say, well, I have a policy at our company that will never drop below 1% of our total assets, or never below 5%. And now we are. So we need to get our cash reserves up. So that would be why you'd want to analyze where you're at with each of these. Things later on when we get into like salaries and stuff, you don't want to, most companies don't want to have their salaries above 30% of their total income, so when we get to income statement, we'll look at that. But anyway, that's what you do. And you do the same thing down here, except for down under liabilities and stockholders' equity, the total liabilities and stockholders' equity is what you used as your denominator when you're figuring out the percentage. So now you're going to find out the total of percentage of accounts payable to your total liabilities, your notes payable to your total liabilities, your total current liabilities to your total liabilities. So again, just do the same thing, 16,500 divided by the base, which is 308,555. And that's going to give you your percentage. In this case, it's 0.053 or 5.3%. That's the answer to accounts payable. Then notes payable would be 10,000 divided by the 308,555. And that's going to give you 0.032 or 3.2%. Anyway, you can do that all the way down as well until you get to the end, and then you're going to figure out the percentage of each. So again, you might say, well, we don't want our mortgage to be more than, it actually comes out to 21.7%. You might say, we don't want our mortgage to be more than 25% of our total liabilities and owner's equities. So then you would make sure that your payment is low enough, or refinance it, or pay some down so you don't have such a high payment. Anyway, those are the ways that you figure out what we call vertical analysis. You do the same exact thing on an income statement, but we'll show you it's a little bit different in a minute. But that's how you solve those problems. And I think, just so you know, most of the problems on the quiz or the exam is you're only really solving for one category. So it'll just ask you about cash to total assets. And so you have to figure out what is the percentage of cash to total assets. And you just divide the amount of cash by the total assets. And that would give you your percentage. So, all right, we're going to move into the next screen then. And we're going to show you a horizontal analysis of a income statement. And that's what we have here. So here again, sorry, not an income statement, a balance sheet. So here's a balance sheet. And this one, if you notice, it has 2 years listed. It has 2015 and 2016. And so 16 is mentioned first, even though 2015 is the older of the two. And so when you're solving for a horizontal analysis on a balance sheet or an income statement, it doesn't matter, they're both exactly going to be the same, is the first thing you need to do is figure out how much of an increase or decrease happened between the 2 years. So if you notice on cash, it says in 2015, we only had $5,430, but now in 2016, we have $8,700. So that comes out to a $3,270 increase, right? $3,270 increase from 2015 to 2016. Well, what percentage of change was that? And that's what you want to determine. So how do you figure out the percentage of change? Well, we know that it's $3,270 difference. So we want to use the difference. This comes back to the formula where we were solving for the difference, right? We found the difference between the two, and then we divided it by the original amount, and then that gave us the percentage of change. So remember, if it was 3270 was the difference, and my original amount in this case was 2015, and you're going to use 2015 all the way down, it's going to be 3270 divided by 5430, because that's how much it was in 2015. That comes out to a 0.060, let's just say 0.6017. I'm going to erase that just to make it a little clearer. I don't know what it comes out to, but I'm just guessing based off the answer. And then I would move that over. That would become 60.2%. And that's the difference, 60.2%. So what does that mean? That means that my cash grew 60.2% from 2015 to 2016. So there you go, 60.2%. And I would do the same thing all the way down. I would find the difference between these two. Get the difference. So the next one is 4660, and that comes out to a 25.3% difference between 2015 and 2016. So again, you're just finding the difference, and then you're dividing the difference by the original amount. In this case, the original amount is always 2015, all the way down. So you do that all the way down, all the way down, all the way down, and you're going to see what amount of change you've had. Now notice, let's look at this one here, notes receivable. In 2015, you had 3406, but in 2016, you only have 2900. So again, you just need to find the difference in this case. So the difference between those two comes out to $500. And usually you reflect that by putting in parentheses. That means that it's a decrease. So a decrease always should be put in parentheses, but you still do the percentage the same way. You divide the 500 by the 34,000, and it comes out to 14.7%. But in this case, it's a decrease, 14.7% decrease from 2015 to 2016. So anyway, work your way through all of those, all the way down the same way. Find the difference, divide the difference by the original year, 2015. That'll give you your percentage of change for each one. And this is true of both income statement and balance sheet. It doesn't really matter. They're exactly the same when it comes to the horizontal analysis. All right, so then we're going to go, now we're going to take a look at an income statement. So this is going to be page number 4. All right. So now we're looking at an income statement. And an income statement, before I look at this one real quick, and I'm going to go to the original income statement I showed you guys a couple of weeks ago. So let me see if I can find that. It is right here. All right. So here is an income statement. I explained this in last week's video for chapter 16, but I'm going to explain it again here. An income statement basically is a snapshot, not a snapshot, it is a how much money did you make or did you lose over a period of time. Typically a year is when they do them. So annually they'll do an income statement, but you could do it at any time from that date to a year prior to see where you're at as far as, income and profit and loss, etc. And that's what it really is. A income statement is also known as a profit and loss or P&L statement. And this just shows you whether you made money over that period of time or whether you lost money, and then of course how much money you've made. And we talked a little bit about this when we were talking about inventory, because I have inventory highlighted there because we were showing, of course, the higher your inventory cost, that means the higher of your cost of goods sold, which means it's going to take down your revenue a little bit more, and means it's going to show that you made less money, but it also means that you'll pay less taxes. But if you have low inventory costs, that's going to show your net sales or revenues higher, and ultimately your profits higher, and that means you're going to be paying more taxes at the end of the day. So it just depends on what you want to accomplish, how you calculate your inventory. But if you notice here, we have revenue, which is basically means every bit of money that you brought in, not counting any of the expenses that it costs to get it. So even though you may have made something for $10 and sold it for 20, you're showing 20 in your revenue. We haven't deducted the cost of goods sold yet. So that's your total receipts, total money that you've made. And in this case, this particular CNF Health and Fitness made 1.65 million over that course of 2022 to 2023 in August. They did have some returns, meaning that people brought stuff back that they had to give money back to. So that gets taken out of their revenue. And then they gave some discounts as well. So that had to be taken out of their revenue. So after you deduct those two, you have a total net sales of 1.629 million. Now you have to figure out, well, but how much did it cost me to make that money? And that's what we call cost of goods sold. That's the materials that went in to making the products. So here you have your inventory, which is the material that you bought or the items that you bought. In her case, she bought stuff from other wholesalers. And then she already had some in stock. She had 556,000 in stock on August 22. Then she purchased over the next year another 678,000 worth of goods to sell. So she had a total available in that year's time of 1.2 million. And then she has left after the year is over 567,000 in ending inventory. So that means, and then she had some spoilage, so she lost that. So she has to deduct all of those expenses from her total revenue. And so she had 1.629 million, but she has to take off the 567,000 as well as the 2,000 that came out to 665. So he subtracted this from that, and that came out to 964,617. That's her gross margin. That means that's what she made after she deducted all of her expenses for making the goods and selling the goods. We call that cost of goods sold. Now she still has her fixed costs or her operating expenses that she needs to deduct. So over that course of the year, she had, of course, salary, she had rent, she had advertising, she had insurance, she had supplies she had to buy, she had some depreciation, etc. So all that came out to $485,000 worth of expenses that she had to deduct from her annual revenue. So from the 964, she had to deduct another 485. So that means her income at the end of the year before taxes was $478,997. But she has taxes on that. So whatever the tax rate was, it came out to $54,000 that she owes Uncle Sam. So that means at the end of the day, she had a $424,656 net profit at the end of the day. So that's pretty good. I mean, she made almost, 1.5 million, and she left with a little bit less than $500,000 by the time she removed all of her expenses. So this is what we call an income statement, and there's an analysis both vertically and horizontally that you do on these, just like we did on the balance sheet. So I'm going to go ahead and open that page for you to look at that. So back to this page. So here we have all of the data that we need for the balance or income statement. If you notice, I already put the categories. So we have revenue, we have cost of goods sold, we have the gross margin, we have the operating expenses, we have the income before taxes, and then we have the net profit and loss. So we can just plug in the numbers to this particular chart here. Let me see if I have it already done for you. I do. Do I? Oh, that was the income statement. Let me see if I do it for the balance sheet. Okay, I didn't do it for the balance sheet or the income statement, but basically we would take revenue. So it says right here, gross for the year ending December 2016, gross sales was 1,356,000. So we'll just put 1,356,000. And then she did have some returns of 93,100. And then she also had some discounts of 4,268. So I would subtract these from this, and that would give me a total revenue after those expenses of, I didn't do the math on it. So let's just say it's going to roughly be about 1.245 million. So that's now her actual revenue or receipts after she's removed the returns as well as the discounts that she gave. And then her cost of goods sold is going to be beginning inventory first. So we'll just put beginning inventory here, and her beginning inventory comes out to, where is it? Inventory January 1st, 2016 was 324,800. And then she had purchases of 179,100. So we would add those together. That would give us the what we call total available for sale. And that comes out to roughly, we'll just round it off, about 500,000. So she has 500,000 total available for sale, but she has freight in charges of 3911. She has salaries. Well, salaries should be later on. Let's see. Yeah, salaries. So she has freight charges, and she has freight in, salaries, rents, utilities, all should be a part of the other ones. So we would just subtract that. I think it comes out to about 495,000. That would be her cost of goods sold. So that becomes now. So we deduct that from the 1245. So roughly we're going to deduct about 5,000, so 500,000. So it's basically going to come out to about 750,000 gross margin. I'm sorry that I'm rounding. I just don't want to have to do the math. It'll take too long. And that gives us, so then we get into our operating expenses. So this is where we have salaries. And they came out to 375,900. And we had rent of 166,000. Then we had utilities of $7,730. Then we had advertising of 73,300. Then we had insurance of 22,940. And then we had administrative expenses. I need to make this bigger so I can fit everything. 84,500. And then the last we had miscellaneous expense. And that was 24,900. So 376 plus 166. This is another 550,000, 650,000, 750,000. Yeah, we're looking at really, really close to being pretty much out of money here. It's roughly 750,000 was what her expenses all were. And so we'll make it a little bit lower for fun. And so that means that she has $10,000 profit before taxes. And then we'd pay taxes on that, or income before taxes. What should I call it? Should be income. And then we would multiply that by whatever the tax rate is. Let's just say that it's 5%, so $500. So that means she would have a net profit of $9,500. I didn't do the math, so I apologize, but I'm just showing you that the way you do it is you have to follow the order of a income statement. And now this is going to be really important on your check-in assignment, or excuse me, your case study, is you have to actually kind of do an income statement. I gave you the whole thing already all laid out in a chart, that you're going to figure out your inventory using all three methods, and then you're going to complete the income statement by deducting and adding what you need to in order to get to the very bottom, which is net profit. On each of the different ways in which you've done inventory, it's going to be different. And so you need to tell me which was the best way of doing inventory, because we want to show a high amount of sales. So you have to select which method of inventory showed that. So that's an income statement. And then I'm just showing you how to make one. As far as doing the next sheet, which is the vertical analysis of the income statement, that's where we get into, let's see, is this it here? No, that's the balance sheet. Sorry, one more. It's 7. This one. All right. So here we're going to do a vertical analysis of your income statement. Now, income statement's a little different because you're going to basically base it off of net sales. So everything is based off of net sales when you're doing a vertical analysis on an income statement. So basically, you're going to do the exact same thing we did for the balance sheet. Is we're just going to figure out what percentage of each of these to net sales are they. So again, we might, as a company, we might say, you know what, I want to make sure that my inventory never goes above a certain percentage of the total sales or net sales. So I would have to figure out what percentage that is, and then I'd figure out how can I get it down or up to where it can meet the requirements. So again, all I'm doing here is the same thing I've been doing. I'm going to take each number, 458,400, and I'm going to divide that by 443,956, because that is my net sales. Everything is divided by net sales. So in this case, it's probably going to come out to, I think it comes out to 103.3%. And that is the answer, 103.3. Because my gross sales is 103% of my net sales. And then I do the same thing. I take my 13,002 and I divide it by this. I take my 1244, I divide it by that, and I would write the percentage in here. And then I would take my 198,700, divide that by this, divide that by this, all the way down. Even the very last one, 41,466 divided by the 443,956. And that'll tell me the percentage of net income, which ends up being about 9.3%. So that's all you're doing. You're just basically dividing the number in the category by the total net sales. And then that'll give you your percentage of each one. So again, if I say, well, my salaries are 124,200, and that comes out to 28% of my net sales. I just divided those two. 28%. Now, some companies say we don't want it ever to be above 30%. That's pretty much an industry standard. Most people try and keep their salaries around 30% or lower, because if not, they're, that means they're a little bit high on their salary side. So they might want to, that's kind of a rule of thumb. Most people keep it about right there. This is 28%, so they're doing pretty good. Royal Equipment Supply. So just keep that in mind, but this is what we call a vertical analysis. And then the horizontal analysis is exactly what we did, exactly the same on an income statement as it is on a balance sheet. And it would just be that we would find the difference between the 2 years. Let me go back to I don't think I gave you one of these to do. Actually, I did. So there's an income statement horizontal analysis. Again, exactly the same. In this case, you're going to have to do the math and add these up, or actually subtract these two from that. Same here to get the total here. And then here, you're going to add all these up and put the total here. So add all these up and put total, add all these up, put the total. And then you're going to subtract this from this, because this is less merchandise. That's what you have left over. That's what you had available. And then that would give you your cost of goods sold. And then your gross margin would be deducting this number from this number. That would give you your gross margin for each. All right, once you've done all that, then again, to find the percentage of change, you just need to subtract these from each other. Usually the higher number from the lower, and then divide everything by 2015, divide the difference between 2015. So again, if I was to do this, I'll write some numbers in here for you. This comes out to 228,500 difference, right? And that comes out to a 22.7% difference between 2015 and 2016. In this case, it's an increase, right? So again, the next category, less revenue, less returns and allowances. So the difference between 121,340 and 99,600 is 21,740. And that is divide this number by this number. That's going to give me my percentage of 21.8% change. And that again is an increase. And then here again is an increase, 51,000 in 2015 to 63,000 comes out to an $11,883 difference. I would divide this 11,883 by the 51,237, because 2015 was the original year. And that comes out to 23.2%. And then if I add all these up, this one here, just so you know, comes out, if I deduct the 121 and the 63,000 from the 1.23223 million, it comes out to $1,038,540. So that's what we call my net sales. And if I did the same thing for 2015, my net sales comes out to 845,663. If I find the difference between those two, that difference is 192,877. And if I divide that 192 by the 845, because that was the original year, it comes out to a 22.8% difference. Now, what is that saying? That's saying between 2015 and 2016, I saw a 22.8% increase in net sales. So that's good to know, right? I mean, that's good information to be able to see. If I saw no increase or a decrease, I might say, hey, what happened? Why did we see a decrease in our net sales? Or for some reason, my returns, they went up 21%. That's pretty high. So I might say, hey, we need to be watchful of those returns and do more to ensure they don't happen, that people are satisfied when they buy it. So anyway, that's what you do here. So again, same thing, you're going to find the difference. You're going to add all these up. So in this case, you're going to add your beginning merchandise, your purchases, and your freight charges. So that's going to give you, if you add all those up, $933,130. Now in an income statement, that's what you had available for sale, but what you have left now at the end of the year is $585,000. So what did you sell? Well, you just subtract the 585 from the 933. That means you have $347,730 left in inventory, cost of goods. Oh, that's your cost of goods sold, sorry. So that's what it costs you. That's what it costs you to sell those products and make $1,038,000. Now, what's my gross margin? Well, if this was my cost of goods sold, I need to subtract that from my gross margin. So the 347,930 should be subtracted from the 1,038,000. So that means now my gross margin after I've removed my cost of goods sold expense is $690,810. So that's now my gross margin, but I still need to deduct all of these expenses still. So then when I do that, I would add all these up. It gives me my total operating expense of $508,900. And then that means my income before taxes is this subtracted from the 690. So that gives me 181,910. So that's how much I had income before taxes. Then I have $66,000 in taxes. So that needs to be subtracted from the income before taxes. And that means I had a whopping $115,630 left. Now, again, you can do that all the way down on this other column and then find the difference, divide the difference by the original, and that'll give you your percentage. So that's what we call the vertical and horizontal analysis of an income statement and of a balance sheet. All right, now we're going to start looking at ratios. And when it comes to your financial statements, ratios are taking data from those financial statements to kind of determine certain factors about your business and how healthy it is or not healthy it is. So we have a current ratio, which is basically taking all of your current assets and dividing them by all of your current liabilities. And of course, this is going to tell you how quickly, or how leveraged you are. If you have a lot of liabilities and very little assets, then that number is going to reflect that you have a lot of liabilities. You're kind of leveraged. Or if it's a really high number, then, obviously or a low number, then you're obviously doing okay. So the current ratio, basically, this ratio shows that a firm's ability to quickly liquidate assets to pay off current debt. The ratio recognizes that a firm's inventories are one of the least liquid current assets. Merchandise inventories and prepaid expenses are not part of the quick assets because they're not readily convertible to cash. So basically, it's how much every dollar of your answer is going to be what percentage of liabilities do you have to every dollar of your assets? And that's what it's going to be reflected as. So for instance, I'll show you a problem in a minute on this, but basically, I think if I go to the next slide, let me try this real quick. So the first one is current ratio. So if you notice here, it's this one here, current ratio. So we're going to compare what our current assets are to our current liabilities. So our current assets, so we're going to take all of our assets, which is basically going to be your current assets and then your current liabilities. So you're going to deduct those. So Super Saver is going to deduct their current liabilities from their current assets. That's going to come out to 318,000 that they have left after they pay all their liabilities off. And then it's going to take the current assets divided by the current liabilities. So if you divide those two together, 450,000 divided by 130. So let's just do that. 450,000 divided by 132,000. The answer comes out to 3.41. So that means that for every liability I have, dollar of liability, I have $3.41 to pay it off. That makes sense? So that's what we call current ratio. And that's what you're figuring out. So your working capital is 318,000. That's pretty good. So let me go back. Well, let's do the rest of these. So if you take your 125,490 and you divide it by the 74,330, that ratio comes out to 1.688. So we'll say that comes out to 1.69 to 1. What does that mean? That means that Impact Builders has $1.69 in assets to pay off every dollar of liabilities. So they're doing okay. The other company's doing better. They had $3 per. And so anyway, you can make your way all the way down. You can, of course, find the working capital, which is the difference between your current assets and current liabilities. So in this case, you're going to be upside down. Notice you have more liabilities. So if I was to divide, sorry about that. If I was to divide the 14,540 divided by the 19,700, that means I have 0.73 cents of assets to pay off $1 of liability. I am leveraged, right? That's not a good thing. I need at least 1-to-1, but better 2-to-1. And so most companies, I believe, like to have at least asset to debt ratio of 1 or 1 is greater is considered acceptable. So 1-to-1 is fine. A little better than that's better, but anything below that, you're in sad shape. So 73 cents for every 73 cents in assets to pay off $1 in liabilities, you're over leveraged for sure. Anyway, you can do the rest of those if you want. I think I included the worksheet, but you can work them out on right now. You can pause the video and you can work them out and see what you came up with. I can probably write the answers in there since I have them right here. So let me do that. This one is $2.88 to 1, and this one is $1.45 to 1 to pay off the debt. As far as working capital, this is 51,160. This one is a negative 5,160, and that's a negative. This one's $2,350 difference, and then this is $379,070 working capital. Working capital, all it is the difference between your current assets and your current liabilities. So, and of course, when you're $5,000 difference and you have more liabilities than you do assets, you're going to be negative. You're going to be in this case a less than $1 to pay off $1 of liability. All right, so that's what we call the acid test. Or current ratio, sorry. The next one's going to be the acid test one. So let me go there real quick. It's right here. So the next one is the acid test ratio. And this takes your quick assets divided by your current liabilities. So this is very similar, but this is really how quickly can you pay off your debt, because your quick assets are the ones that are going to be able to be turned to cash the most quickly. So let me read to you. Quick assets are things like cash, marketable securities, stocks that you can sell right away, and any accounts receivable. Those would be only things considered quick assets. And so your quick asset and your current liabilities, basically, this shows you that, that was the one I was reading. The ability to liquidate assets to pay off current debt. So the other one, I apologize, it's really called current ratio, and that is the comparison of a firm's current assets to current liabilities. This ratio indicates the amount of current assets available to pay off $1 of debt. So actually, it's 2 to 1 on this one. They want you to be at least $2 to 1. On this one, they want you to be at least be 1 to 1. And this one here is taking your quick assets like your cash, your marketable securities, etc., accounts receivable, and be able to turn that to cash to pay off your liabilities. Where current assets involves inventory, and that's where it can take a little longer, and that's why they want your ratio to be higher. So anyway, when figuring the acid test ratio, we'll look at that. It's exactly the same thing we just did, but the only difference is that we're going to be figuring out what are our marketable securities. So here we have them already, marketable securities, accounts receivable. So all you're doing here is you are, and we're using the same liabilities as the prior company. Notice it's Super Saver, Impact Builders. So it's the same, everything's the same, but now we're just doing what we call quick assets. And that's cash, marketable securities, and accounts receivable. So we're going to add up all the quick assets. So you're going to add these up all the way across. That comes out to 187, 120. The next category comes out to 95,920 for impact builders. And then the acid test, again, is you just use the formula that we had. So you're going to take your quick assets, which in this case was 187, 120, and you're going to divide it by your current liabilities for that company, which was 132. So 132,000. If I divide that, it comes out to this 1.42 to 1. So the answer to this was 1.42. So that means I have $1.42 of my quick assets to be able to pay off my liabilities. Again, they said they want that to be at least 1 to 1. So you're fine here. This one they want to be 2 to 1. And we had when we had these filled out 1.69 to 1. 0.74 to 1, 2.88 to 1, and 1.45 to 1. All of these except this one and this one are outside of the ideal. You should be at least 2 to 1. Every $2 of assets to pay off $1 of liabilities. Now that's your total current assets. But your quick assets are just cash, marketable securities, and accounts receivable, and that needs to be at least 1 to 1. And this one was 1.42, and then this one here comes out to 1.29 to 1. So that means that you have $1.29 of your quick assets in order to pay off your current liabilities. So you're still doing good because you're 1 to 1 on that. I think if you go to the next page that I put together here, I have more quick assets. So here's the rest of those. So they have no market accounts receivable or no marketable securities, but they do have accounts receivable. You have to add all those up. So these here on the next page come out to, I'll write them in for you. Your total quick assets here comes up to $7,020. Your total quick assets here comes out to $2,165. And then your total assets along the bottom come out to $914,700. So again, I would divide these by the marketable or the current liabilities of the page before, and this comes out to then 0.36 cents to 1. This one comes out to 1.73 to 1, and then this last one comes out to 1.08 to 1. So since it's 1 to 1 on this, all of these are good except this one. Thunderbird Electronics is over leveraged, and you can, $7,020 was their total quick assets, but their current liabilities for Thunderbolt was 19,700. So they were quite leveraged on their quick assets. So, all right, so that is the first two. That is current assets, and that is quick assets. Now we're going to move into the next. And the next one is inventory turnover. And this is a very important one for you to know. There is a formula for this. I'll write it down here, but basically it's inventory turnover equals cost of goods sold, so COGS, divided by average inventory. So that's the what we call the inventory turnover. So here we have your beginning inventory, your ending inventory, your average inventory, then we have your cost of goods sold already given to us. So we would just plug these numbers into the formula, but of course we need to figure out average inventory. So basically we need to deduct, let's see, yeah, we would, hold on a second. Okay, sorry, your beginning inventory plus your ending inventory divided by 2 is your average inventory. So you would take the 1,547,000, the 1,366,000, add them together and then divide them by 2, and that gives you your average. So you do the same thing here. So you add these and then divide by 2, add these, divide by 2, etc. So that brings you all the way down. So I'll go ahead and just fill those in because I already have them completed. But that's how you would figure out the average on each of those. So the average inventory on this one is 74,447.50. The average inventory on the next one would be 900,405. The average inventory on certified fabrics would be 105,650, and then the prestige hardware, the average inventory would be 306,645. And then again, we would just use this formula here then to get inventory turnover. So your cost of goods sold, which are here, I already given them to you, divided by the average inventory. So basically, you're just going to divide these with each other. And our answers come back 6.6, 3.8, 6.2, and 14.2. What that means is that, I'll read it to you, the meaning of the inventory turnover is the inventory turnover is a ratio that should be compared with the data from previous operating periods and with published industry standards or averages for a similar size firms, the same industry, to draw meaningful conclusions. When inventory turnover is below average, it may be a sign that the company is carrying too much inventory. Carrying excess inventory can lead to excess expense, such as warehouse costs and insurance. It also ties up money that could be used more efficiently elsewhere. So the numbers that you're given are really based off of years prior in your own company or industry standards that are out there. So if you have a company that's the same size as yours, roughly same revenue, what does their inventory numbers look like compared to yours? Because again, if it's too slow and you're not turning your inventory over quickly, what this means is what's going in is being sold. Well, how quickly is it being sold? If it's just sitting there on the shelf, it's money on the shelf and it's a waste to you. So you want to be able to turn it over quickly. And so in this case, the quicker the better in most cases, but is it good or not? It depends on the industry and your prior years. But 4.5, meaning that, that maybe 4.5 days versus 14.2 days to get those things processed. So, all right, so that's inventory turnover. That is a ratio that you'll want to know about. All right, the next one we're going to look at is what we call debt to asset ratio. And this is going to be looking at data from your income statement or your balance sheet once again. So we're going to figure out what is our owner's equity. We're also going to figure out what is our debt to equity ratio. So we have debt to asset ratio. So this is going to be basically, let's see, we'll draw it up here, the two formulas rather than go back. Debt to asset, and then ratio. And then we're going to have a debt to equity ratio. Now, the debt to equity is saying, how much debt does the owners owe based off of what they have in the owner's equity. And then your debt to asset ratio just, again, shows you what is your percentage of debt to your assets. So current liabilities versus current assets, and then your, sorry, I'm on the wrong sheet here. Your total assets, total liabilities, and owner's equity. So the formula for the debt to asset ratio might help if I show you this. Your total liabilities, the total liabilities divided by your total assets. Now, this is not current, this is total, and that's the difference. Before we were just looking at current assets, current liabilities. Now we're looking at total. So that's going to be your ratio for your debt to assets, and then your debt to equity is going to be the same thing. You're going to be your total liabilities versus your total owner's equity, OE. And that's going to be your debt to equity ratio, your debt to asset ratio. So if I follow this order here, first thing I want to do is I want to figure out, like for each of these companies, what is the owner's equity? So that's going to matter in the answers that I give. So my answer to this is there's 117,000 and 110. How I figure that out again is, remember, I just minus my assets, subtract my liabilities. That gives me whatever's left is my owner's equity. So the next one, Reader's Choice Books, is $155,390, and then the last one, I can't fit it, but it's $685,900. So those are my owner's equity. Now I need to figure out my debt to asset ratio and my debt to equity ratio. So again, I just use these formulas. So my total liabilities is 535,000 for the first one, divided by my total assets. My total assets were 1.4 million. So if I do the math on that, it should come out to the 0.38, and that 0.38 is to 1. So my debt to asset ratio is 38 cents for every dollar of debt. 38 cents of debt for every dollar in assets. That's what it means. So all right, the next one would be 115,320 divided by 232,430, which comes out to 0.50 to 1. So my debt basically means that I have 50 cents of debt for every dollar of asset that I own. That's what it's telling me. And this is, again, total assets. All right, and then the third one, I would just use the same formula again to figure it out. I would divide the total liabilities by the total assets, and that comes out to 70 to 1, 70 cents for every dollar. And then the last one, 685.90, comes out to 76 cents of debt for every dollar of asset. All right, so that's the debt to asset ratio. And then again, the debt to equity is the same thing, except for I'm going to be using the owner's equity instead of the total assets. So again, I would do the 117,110 for Gateway, that I would divide that, instead of dividing it by the 512,000, excuse me, the 232,000, I would divide it by the 115. Sorry, I did it wrong. I have to do my total liabilities is 115,320, and I would divide it by my owner's equity, 117,110. And the answer to that comes out to 98 to 1. That would be my answer, 98 to 1. So for every dollar of equity that I have 98 cents worth of debt. I think that's right. Or 98, yeah. Or $98 of asset. That's $98 of, that's 0.98. So let me read it. Hold on. It says debt to equity ratio is used as a safety factor and measure for potential creditors. The ratio compares the total debt of the firm with the owner's equity. It tells the amount of debt incurred by the company for each dollar of equity. It is commonly expressed as a percent. So 98% to every dollar is my debt to equity. So it's not really too good. It should be a lot less than that, right? The next company, Reader's Choice Books, their debt to equity ratio comes out to 2.30 to 1. So if you notice, they have a lot more debt than they do owner's equity. And so it's going to be over like that. So it's $2.30 of debt for every dollar that they owe that they own. So not doing too good there. And then this one here is a little better. This is only $2,000 in debt, and they have $685,000 in, or it's no I'm sorry, it's $2 million in debt and only 685,000. So it comes out to 3.19 to 1. So they are very leveraged. None of those look healthy to me. So anyway, that's what we call debt to equity ratio. And then I didn't read to you the debt to asset ratio, but basically debt to asset ratio measures what degree the assets of the firm have been financed with borrowed funds or leveraged. The ratio identifies the claim on assets by its creditors and is commonly expressed as a percent as well. So, all right, that is those facts. Okay, the last two ratios that we're going to look at is what we call the net profit margin, or gross profit margin and net profit margin, and then your return on investment. So as far as the formula, they've given you all the factors here. You just have to figure out the differences. But your gross profit margin, I'm just going to do a gross profit margin, and then your net profit margin. Their formulas look like this. Gross profit margin is basically gross profit divided by net sales. And then your net profit margin is net income divided by net sales. And by the way, you can look all these up in your book on pages 507 through 509. And so I'm just going to use the table that's provided there, and then return on investment is the last formula, and that one is basically net income divided by owner's equity. All right, so this is using something from both. This one here is using something from both the balance sheet and the income statement. So this one, gross profit margin. So first thing I need to do is figure out what is my gross profit. So I'm going to take my net sales. I'm going to minus the cost of goods sold on all of these. That's going to give me my gross profit. Remember, it's after my cost of goods sold. So that comes out to 253,940 here, comes out to 149,410 here, comes out to $113,080 here. And then I need to deduct my operating expense from my gross profit to get my net profit, right? So again, I would take my 253,980 and minus the 175,410. So that comes out to 78,530. Deducting those two from each other comes out to 50,210. And then the last one, dynamic optical, subtracting the 85,000 from the 113 comes out to 27,159. Now I would just plug in the numbers in these formulas. So again, if I'm figuring out my gross profit margin, I would take my gross profit, which is 253,940, and I would divide it by net sales. So my net sales are this number here, the first number. So it would be divided by 743,500. And the answer to that comes out to, it looks like 34.2. It's a percentage. So that would be my gross profit margin there, 34.2. And then again, to give you a little bit of what this means, it is an assessment of how well the cost of goods sold category of expense was controlled. In particular, this measure spotlights a firm's management of its purchasing and pricing functions. Gross profit margin is expressed as a percent of net sales. So there you go. 34.2% of net sales is my gross profit. So again, if I'm showing that I'm really controlling my costs of inventory and all that, I probably would see a lower percentage. And then if I have a lot of expense, it's going to show a higher percentage of net sales. And then the same thing here for the next one. So now that I have the net profit, so the net income is going to be 78,530, and I'm going to divide that by net sales. So net sales again was 743,500 for that one. And the answer to that comes out to 10.6 or 0.106. So 10.6. And these are usually all percentages. So all I'm doing is following the formulas that I have for these. So again, the same thing we would do on the next problem is we would just do the next one. So the next one would be gross profit of 149,410 divided by 324,100, and that gives me a 46.1.461. So 46.1%. And then the net income on that one was 50. So I'm going to do 50,210 divided by 324,100, and that comes out to 15.5%. So again, you're just using the formulas, solving these, and then again, what they tell you is what I just read. Net profit margin, just so you know, this is an assessment of the management's overall ability to control the cost of goods sold and operating expenses of the firm. This ratio is the bottom line score of a firm's profitability and is one of the most frequently used ratios. The net profit margin can be calculated either before or after income taxes. As with the gross profit margin, is expressed as a percent. So this net profit margin tells you really how much income that you made off of your total sales. So basically what you brought home after all of your expenses was 10.6% of the total. 17.7% on the first one, Plant World. Timberline Marble brought home 10.6% of their total sales. And then Sundance Plumbing bought 15.5% of their total sales. And then if you do Dynamic Optical, it comes up to 8.6% of its total sales. So that means that they probably didn't control expenses too much to not even have made 10%. You know, they're basically saying we made 8%. On the last one, 8.5%, we made 15%. So 17, 10, 15 is probably fairly reasonable to say that we made 10% profit at the end of the year, or 15% profit. That's pretty good, but the 8% might be a little low, so they might want to consider their expenses and how they can save some money on expenses to get that profit margin higher. So, all right, then the last one's just return on investment. So this is where you're going to take your owner's equity, and the formula for this particular ratio is net income versus owner's equity. So again, we're using the same companies here. So we're just going to take their net income. So the net income's here, 78,000. So we'll just do the first one, $78,530. And we're going to divide that by owner's equity. We're given the owner's equity of Timberline right there. It's 434,210. So we would just do the math on that, and it comes out to a whopping 18.1%. So that's the second one, 18.1%. And if we go down and do the same thing for Sundance and Dynamic Optical, this comes out to 8.2%, and then this comes out to 6.8%. And again, to do return on investment, here's what it means. This is the amount of profit generated by the firm in relationship to the amount invested by its owners. So in other words, we made 6.8% profit based off of my investment as an owner of this company, or 8.2% profit, or 18.1%, or even better, 21.6%. So the higher the number, the more you're making money off of your money, is what it's stating. So those are ratios. They're not difficult. I think just understanding them. I mean, I read to you the definition from the book, but I promise you that you're going to not remember what they stand for. But don't be afraid to reference the pages of your book in chapter 15 on the different ratios. And these are not difficult. You will be solving some of these on your check-in assignment. There are some of these on your quiz and exam. So all you really need to do is to know what numbers to put into the formula and where to get those numbers. And sometimes you do need to do the math to get the number you need. And that would be part of your understanding how to put together an income statement or put together a balance sheet. So hopefully this was helpful. I apologize for the sloppy writing. I am buying a new system that's going to allow me to be much more precise. The iPad is very finicky. When I touch it with my hand, it moves things around, as you guys saw. So I apologize for that. Hopefully I'll be doing another video next semester that will improve this one. But until then, you have this one as well as the one I did last semester. So hopefully it's enough to get you through these assignments. I'll be doing a separate video for chapter 21 on statistics. But have a great week, everybody, and we will look for me on the next video.